Hello, everyone, and thank you for joining us for another episode of the Financial Commute. I'm your host, Chris Galeski, and here to join me is wealth advisor Jon Wingent. Jon comes from a lot of experience, both of giving advice here in the U.S. to clients, but also internationally based in Europe as well. Jon, we're here to talk about international investing and that home country bias. And it was really interesting. Recently, I was part of a study group with some firms based in Australia, and we were talking about this home country bias when it comes towards investing. And it was fascinating. Now, I know that there's tax benefits and other reasons, but it was fascinating to me that about 80% of their equity exposure over in Australia was to Australian companies. And so to me, as an investor in the US, I'm like, wow, you're ignoring companies like Microsoft and Apple and Visa and Google and Amazon, compared to the home country bias we have towards investing here in the US. I know that you've got a lot of experience in terms of giving advice to clients, both here in the US and over in Europe. Tell me about your experience towards investing in international or domestic and that home country bias.
Yeah, no, Chris, I think you make a valid point because there's always that natural bias towards where you are because the countries are there, the companies rather, sorry, and you know them. Yeah. They are products, brands that you use. So a UK consumer is going to know a UK company, and they see that in their portfolio, and they're running pension funds, yeah, and they see that in their pension. They're familiar with it.
Yeah.
And I would say when I was working in the UK, we would naturally have quite a large bias to the UK.
So like how much in terms of exposure? If you look at your equity allocation in general, like what exposure would you have to European countries?
So to UK, well, interesting actually, you make a point there, you say European, because yeah, in the UK as well, you've got a bias towards UK, right, and then you've got Europe as well. Often a lot of funds will be run, they'll have the title UK X Europe or UK.
Okay.
So I would say UK alone, so I'd be talking about a traditional investment manager. There's a lot of global investment managers there, but traditional domestic investment managers would have over the half of their portfolio in UK.
Yeah.
Probably somewhere in the region of 50 to 60%.
Wow.
Then also there'd be European exposure. That would be a lot higher as well, because again, geographically it's closer. They're companies, they're a large trading partner with the UK, so they are again, yeah, companies that we know there. The typical European exposure would be somewhere in the region of 20% of the equity allocation. But yeah, that's certainly a home bias, and then also probably a larger European allocation that you might have, like compared to yeah, the US, for instance.
So what have you noticed here now that you're giving advice here in the US? I know here at Morton, when we're doing stock exposure for clients, we're going to be about 60% US, about 40% international. But what have you seen or encountered in conversation with clients or looking at their outside accounts? What have you noticed that's interesting to you?
Well, I've always noticed, coming from the UK, I've always actually noticed a domestic bias in the US. So, I've looked after US investors, international US investors as well. So Americans living and working, yeah, in the UK. And there's always a tendency for a home bias. Again, it's that familiarity with the companies. And actually, we used to have an expression, you wouldn't likely have that expression here, but in the UK, we used to say, because the US is such a dominant equity market, it is really the main equity market on a global basis, that if the US sneezed, the world would catch cold because it's such a dominant market. Yeah. So if you are a domestic American investor, and when I meet and speak with clients here and investors, they are largely exposed to the US. They're comfortable with it. Often the international exposure, again, would be large global brands, again, because of that familiarity. I keep coming back to the word familiarity, but you tend to find that the international exposure, when I look at international exposures here, yeah, like you said, maybe around 40% of the equity allocation is to international. There will be a big brand. So you'd have Samsung, yeah, from Korea, for example, right, in the portfolio. So companies that you know.
So how would you answer the question that a client may ask of like, man, why would you want to invest in international, more international versus U.S., or have such a high exposure to international companies? If 40% of our allocation is dedicated to that, how would you answer that question?
I simply did diversification, because the same way that we would diversify across asset classes, within that asset class itself, the equity allocation, it adds further diversification. They are uncorrelated. There is a stronger correlation, certainly because of the same asset class, but there's still a larger dispersion between what's happening in US domestic. There's also the currency issue as well. The dollar's pretty strong at the moment. That's probably hurting the US on the export side of things. Right. But if that's hurting US on the export, are there international countries there that are maybe benefiting from a weaker dollar? So again, currency has a big factor in that. In Europe, most of the countries in Western Europe have adopted the euro, so you've got a pretty consistent currency across there. Obviously, the UK has maintained pound sterling.
That's right.
So that has big impact. But diversification, it's simply keeping your eggs across different baskets within the same asset class.
Yeah, we had another podcast with the managing director of investments here at Morton Wealth, Sasan Faiz, and he mentioned that lost decade here in the U.S. from 2000 to 2010, where U.S. markets were flat to down small, but international actually did quite well during that time period. And so no one has a crystal ball to tell what's going to happen the next 12 years, the next 10 years, but we could potentially be facing some headwinds in the U.S. with inflation, higher interest rates, not as good of a monetary policy for the U.S. market. So, sluggish growth, but valuations over in Europe are a lot more attractive in terms of prices. But plus, if you look at the S&P 500, he mentioned that around 40% of their growth comes from international countries as well. Mm-hmm. So if you're investing in the U.S., you have some indirect exposure to the international markets as well.
Oh, yeah, undoubtedly. I mean, you have international companies that will be generating revenue and cash flow from, internationally. You've got some of the world's largest companies in the US. Look at Apple, Google, the FANGs, Facebook, Apple, Netflix, Google. They are adopted globally. They're just as big. I don't see any difference between Apple products in the UK than I do Apple products in the US. Just as many people are using them. Right. Everyone will get out their smartphone. It'll either be a Samsung or an iPhone. So there are large. None of these companies that I mentioned, by the way, are endorsements for investments. But it gives you an example. There's a lot of global companies in the US, so a lot of revenue is generated. A lot of revenue is generated internationally.
Look, I really appreciate having you here and talking about that home country bias that we all have towards, investing. But it's really apparent that we need to take our emotions out of some of these decisions and make sure that we're properly diversified. We're looking at, strong fundamentals and valuations when making decisions, and, just sort of putting ourselves in check when we're looking to make investment decisions. So thanks a lot, Jon.
Absolutely. Thanks, Chris.
Yeah.